Hey guys, hello everyone. Today, once again, we have a non-standard video. Together, we're going to try to figure out why, in such a measured and seemingly straightforward area of trading like algorithmic trading, where robots do all the work and people should be happy, 99% of people still don't achieve any success. Basically, they either just lose their deposit or give up, realizing that they just can't manage to make any money. I'll show you in practice what I think are the most obvious mistakes that beginners, especially traders and algorithmic traders, tend to make. And even experienced traders will probably hear something interesting for themselves, something that might help them look at the situation from a slightly different perspective. And at the end, I'll share one method that always works literally 100% of the time. It will definitely help you. Oh, and I'll also throw in a bonus, limited access to my strategy. So this video is going to be really interesting. Go ahead and subscribe to my YouTube channel in advance, join my Telegram channel if you want to chat, give this video a like, and leave a comment to help the YouTube algorithm promote this video. Thanks in advance to everyone. My name is Maxim. Let's dive in and figure this out. And the first thing that immediately catches my eye, judging by the comments in my Telegram channel and on my YouTube channel, is that for some reason everyone thinks trading is easy. Like, you just, I don't know, quickly find a strategy on YouTube, have ChatGPT put it together for you, and that's it. And then you expect mountains of gold, just because the video showed that this strategy is profitable. But that's not how it works at all, guys. Usually, they just show the basics, the foundation of the strategy. Because if they showed every single nuance, the entire strategy for algo trading, the videos would just be, well, astronomically long. And who would do that for you for free anyway? Why would anyone do that? And if you just stop being lazy and show a little more ingenuity, patience, and drive to succeed, you'll usually get results. It's like that picture, you know, where someone is digging with a pickaxe and they're literally just a centimeter away from a mountain of diamonds, but then they turn around and leave. So don't give up too soon, because if the basic strategy you saw in a YouTube video, whether it was mine or someone else's, if at its core it makes sense and looks like it could be profitable, then you can tweak it until it actually is profitable. Let me show you using the strategy from the previous video, actually. This is what the strategy looks like in its basic form. You just launch it, set everything up as described in the video, and run it. This is how it looks. It doesn't seem all that interesting, right? But this is what it looks like after we improved it together with the guys from the Telegram channel. You have to admit, it looks a lot more interesting now, and the second common mistake is forcing the results. You know, when a strategy is just blindly trained on some data, like for a short period, maybe a month or two, and it shows some absolutely fantastic results. But if you try to run it, say, over a longer period, the results are completely different. This is called overfitting. Let me show you, and then I'll explain what the actual mistake is. Look, here's the strategy on 5-minute intervals, and I'm running it over a year. As you can see, the result is drastically different. And in my opinion, this mistake happens because people don't understand what they're supposed to do. So, how should it be done? So look, I have this strategy, and it seems to be showing some decent results, looks good, but it's not perfect, right? So you want to make it better. And you start tweaking these tiny little percentages, setting some micro values, and on a short time frame it shows you some results, but then it stops, and your tweaking doesn't bring any real benefits, because it's just overfitting. That's actually not the way you should be doing it at all. You need to analyze the strategy and understand what could actually improve it. Let me show you how it's done. I'll demonstrate using my own R1 strategy as an example, which is publicly available. You can use it too if you want. How does it work? It's a momentum-based strategy. When it detects a strong enough impulse to break through a resistance level, it enters the market and tries to ride those impulses. If the impulses go up, it goes up. If the impulses go down, it goes down. So, it's a momentum strategy with pretty decent results as of today. As you can see, that's 9 months, so it's not exactly a short period of time. But as you can see, for about the last month, it's basically been treading water, because the market hasn't been very impulsive. That's why the strategy can't make steady profits right now. There's no clear trend, no direction of movement. So, should I retrain it so it learns from this current period now? But then next month, it won't show anything. You have to take a different approach. You need to understand what your strategy is doing and what tools you can use to improve its results. So, if my strategy is momentum-based, it makes sense for me to measure whether that momentum is following the trend, whether it's moving with the trend, and, roughly speaking, how strong that momentum is. Accordingly, there are special indicators for this. There are plenty of trend indicators. I use them in this strategy. Let me just show you. Look, you see, I use this MA here to smooth out the impulses, so that if, for example, right here, you see, another impulse appears, then a second impulse, a third impulse, but they're all above the MA. So, in theory, a short position should have been opened against the trend, but my strategy forbids doing that. Initially, it didn't forbid it. That is, this filter was added later. Here it is, the MA filter. Where? Here it is, the MA filter. Look, I turn it off, and now the strategy, as it was originally, enters any impulse, whether it's with the trend or against it. You see how much less stable it has become. I also use the ADX parameter for smoothing, meaning to ignore weak impulses. Look, if I also turn off the ADX parameters, it will become even more volatile, even more aggressive. And if I also turn off the ATR parameter, then it will get completely wild, especially lately. You see, I use several filters at once, which basically help my strategy become much more consistent, much more successful. With two of these filters, I prevent the strategy from trading against the trend, against the main movement, and with one filter I measure the strength of the impulse, whether the impulse we've caught is strong enough to enter. Because trading on weak impulses is risky, they can just get completely rolled back. But I didn't just make up these filters or randomly pick their values. I understand exactly what these filters do and why they help my strategy. That's why this isn't curve fitting, it's more like refining the trading system. That's exactly what I mean when I say, don't be lazy, you can achieve results, you just need to think it through. By the way, if you're interested in these kinds of filters for algorithmic strategies, let me know in the comments. Maybe I'll make some videos and show you what other filters you can use. Because if your strategy isn't momentum based, but, for example, works on a bounce from some level, not a breakout, but a bounce, then you'll need completely different filters. And the third mistake, in my opinion, which is actually pretty important, is psychological, it's all in your head. For some reason, a lot of people think that the stock exchange, the market in general, or the banking system was created to give you a way to make money. No, it was created so that rich people, market makers, or someone else could take your money from you. That's exactly what it's for. And the market maker, especially with volatile assets, pulls off such manipulations, it's just insane. Now I'll show you the latest one, literally from just yesterday. Look, this is a 1 minute, let me emphasize, a 1 minute chart of an asset that's worth more than $500 billion. That is, over $500 billion in market cap. And it just dropped 3.5% in a single minute. Just in 1 minute, guys. And it just wiped everyone out, right? Well, everyone who could be taken out, and then it just went up without you. And working with a volatile market means working in these kinds of conditions, where you're basically playing against the casino, and you really only have one chance, which is perfectly described, in that old joke about two guys in the savannah who see hunters and lions, and one of them, bam, started quickly taking off his shoes and putting on sneakers. The second guy asks him, "What, you think you can outrun the lion?" "No, I just want to outrun you." That's exactly how it is for you. You don't have any other option, you just have to run a little bit faster than the crowd, so that this huge lion devours them, and you, along with him, I don't know, like coyotes, jackals, or vultures, finish off the leftovers. And it sounds sad and doesn't look very nice, but that's how it is. You don't stand a chance against the lion, because the lion is the casino, you won't win. You can't beat the casino, it's impossible. If you treat the stock market, algorithmic trading, or any kind of trading as a game, you'll lose. You can only make money. You should never stop trying to improve your strategy. If you see that your strategy is underperforming somewhere, like you notice that during a certain market period, it's lagging. What can you do about it? You need to think it through and try to put it into practice. Like I showed you, you can add 4 or 5 filters, if they actually help you, of course. And here we come to probably the last mistake, at least among the obvious ones, that I see almost everyone make. It's a lack of understanding of the market structure. For some reason, everyone is trying to find a unicorn. In other words, they want to conquer everything with a single strategy, super volatile markets, not so volatile ones, completely non-volatile ones, stocks, crypto, I don't know, currencies, metals, even dabble in a bit of gold trading. But no, it doesn't work like that. There are no such unicorns. So, if a strategy works well, for example, on the dollar Swiss franc pair, well, that's those old-timers on MetaTrader 5 who've been trading on it for ages. There, it's clear you can take a strategy, test it, pull up its 5-year chart, train it on those 5 years, and it'll keep working for the next 5 years, because the volatility of that instrument is about 0.5% a day, or maybe 0.3% a day. So basically, it just moves about 0.3% a day. It's pretty much just treading water. And it's clear that you can run a strategy there over 3 to 5 years, or probably even longer. There's a huge amount of historical data, so you can basically do all of that. But when you're dealing with volatile assets, you can't do that, because a year ago the market cap might have been, I don't know, $100,000, and now it's $500 million. You see what I mean? So, it's basically a completely different asset. An asset that's worth $100,000 is like some 10th tier thing, and an asset that's $500 million, you can't just manipulate it that easily anymore. Although, as you've seen, anything can happen. But at least that cost people a ton of money, and there was a reason behind it. And that's why you need to check, for example, an asset or a strategy that works, say, in a trending market, or maybe right now it works when the market is flat, but in a trend it could wipe you out or perform much worse, and you'll have to filter it again. So, you need to cut off a strategy that works in a flat market, put in filters that prevent it from operating during a strong trend. Basically, you end up with reverse filters. I just showed you a strategy that trades with the trend, that trades on momentum. It needs to check the momentum to make sure it's valid, to make sure it's strong. But if a strategy trades in a flat market, it works completely differently and needs different filters. Let me show you now. Here's another one of my strategies, which is based on zones with high volume, meaning it bounces off liquidity zones and works on a higher time frame. This is a 1-hour time frame with, basically, these kinds of results. So, I have to constrain it with indicators like the RSI to prevent it from trading in the upper and lower ranges, and in this way, increase the number of profitable trades. Look, when I turn off the RSI, I lose almost 10% of profitable trades. As you can see, I'm not trying to find a unicorn in a darkroom, especially if it's not there. And now we come to the main point, the conclusion. So, what should you do then? Guys, you need diversification. You need a lot of strategies. You need strategies for one thing, for another, for a third, for all phases of the market. And then, when there's a trend, you have a strategy that works with the trend. As soon as the trend ends, ideally your filter should automatically turn it off, or you can do it manually. But then you have to determine yourself that the trend is over, and at that moment, either you manually turn on, or it automatically switches to a second strategy that works in a flat market, that works on rebounds, in low volatility. And in this way, all phases of the market will be covered by different strategies. You shouldn't get stuck on just one, thinking, that's it, I found the Holy Grail, I've bought the Holy Grail or whatever. You need to learn, you need to work, and you need to develop your pool of strategies. That's why 2 strategies are better than 1, and 4 are better than 2. You get the logic, right? That's exactly what we do in the Telegram channel. That's exactly why we decided, together with the guys from Telega, to create an educational product on how to build these strategies, how to make a lot of them, and maybe even start some kind of club for algorithmic trading enthusiasts, which I'm inviting you to join as well. See you next time.